Good morning, and welcome to Kenny and Sam's Construction Law Risk Series. My name is Chris Kenny. I'm a partner at Kenny and Sam's, and I'm with my partner today, Matt Welnicki, who's also a partner here. We provide these services to our clients. We have a robust construction law and insurance law program at our firm, and today we're going to cover some of the essential issues of insurance law that apply to contractors. Matt?
Thank you very much, Chris. Welcome, everyone. The first question that you should ask yourself with insurance is, what is it? There are really two ways I like to look at insurance. One is it's a product. It's something you purchase. It's something you have. The second way I look at it is it's a contract. It's not a magic bullet. It's not going to protect you in every instance, which is why you need to be carefully examining your policies and what you actually have purchased as the product. So one of the problems is insurance documents, insurance policies are often large. They're several pages. So you need a way to distill down in a quick way what exactly you need so you can ask questions about it and get more information. Now, the first thing you probably should do is take a look at your certificate of liability insurance. Something that looks like this. It's on an ACORD form. There's several boxes. This will indicate what insurance you have, whether it's workers' compensation insurance, automobile insurance, commercial general liability insurance, or something special that you may have had. Excess is also included on there. The next thing you probably want to do is take a look at the declarations page. Much like the certificate of insurance, a declarations page will indicate how much insurance coverage you have. It'll indicate the premiums you're paying, a whole host of other very important information. But attached to that declaration page is often a schedule of different forms and endorsements. This will list a number of things that either expand or limit what coverage you might have. There'll be things like additional insured provisions, which Chris and I will talk about in a little bit. And there'll be weird things in there, words like subsidence, which is earth movement exclusions, right down to terrorism risk disclosures. So it's important that you take that document, the schedule of what endorsements you have, and take a close look at it. Cross out anything for your initial review that might seem like it's just informational only, and circle or highlight ones that could really impact your business. The additional insured exclusion, anything that describes something specifically that your company does are very important to highlight or circle.
Matt, you make a good point on distinguishing between things that are for informational purposes only and things that are actually part of the insurance policy. Matt showed you a certificate of insurance that's commonly on what's called an ACORD form. And it says right up there conspicuously that this document, the certificate of insurance, is for informational purposes only. It confers no rights on the certificate holder. It does not amend or grant coverage on the policies listed on it. It's really just an informational document. As Matt said, get to the policy, get to the forms and the endorsements, which are the contract for insurance.
Thank you. And one of the ways you can look at the different endorsements is think hypotheticals. Ask yourself, if this happens, what coverage exactly do I have? For example, if your employee is hurt on the job, who is your employee going to sue? What insurance is that going to cover for you or others? We talk a lot about the additional insured provision. That's something you need to take a very close look at. So one other question I like to ask myself or ask the insurance agent, again, you're working with people within your company to find out these answers. You don't have to go it alone. You can always contact your attorneys, which is something that we recommend, but you definitely want to be thinking about these things. So one thing I like to think about and advise my clients to think about is, let's say I have a contract that requires me to indemnify someone. Is my insurance going to cover my indemnity obligations? So you have to think about it in that perspective, and those hypotheticals can be very valuable.
Oh, you're absolutely right, Matt. And you mentioned the insurance agent or broker. For you contractor clients, your insurance agent or broker, just like your lawyer and your accountant, they're part of your cabinet. They're part of your risk team. So take full advantage of their expertise. When you're confronting an insurance issue, really at the beginning of any new contract or project, make time to make sure that either you or your risk manager or someone in charge of the insurance program meets with the agent or broker. Take advantage of their expertise. Ask them questions. There's a full panoply of insurance products out there, and they're not all the same. For example, when you get an insurance product, you're going to get first what's called a grant of coverage. The policy covers certain risks. And then there are going to be exclusions to that coverage. And yes, there'll be exceptions to the exclusions. So you want to make a fully informed decision. As the saying goes, knowledge is power. So take full advantage of the expertise and resources that your agent or broker has. There are many different types of policy forms. Matt provided me today with a bulletin that came out from Selective Insurance, a very good carrier, and it deals with different types of coverage for additional insured status. You'll hear more about additional insured status, but it's essentially when you are getting coverage on someone else's policy as part of the construction contract. Sometimes you're not getting exactly what you think you get, so make sure that you run by the agent or the broker which additional insured endorsement you're getting for the additional insured coverage.
And the question always comes up, when should I do this? Well, you should do it when you start your business. You should do it probably every year, every 6 months, but certainly if you're changing your operations is all. Chris showed you a bulletin from Selective. Let's say you have 3 employees in year 1 and you elect for certain types of coverage. You start growing your business, which is great. But as you're growing your business, possibly as you're expanding into different lines of business, if you're a contractor doing one type of services and you expand to do another type of services, meet regularly with your team that Chris mentioned to make sure you're getting exactly what you need. Make sure if you originally got the gold standard and you're growing, maybe move up to the platinum. So it's not something that's static. You should always be looking at what your insurance coverage is for your particular needs.
And insurers are just businesses like your business, and they have ratings and rankings. So make sure that you know, for example, if any particular insurer is in insolvency, is part of an assigned risk pool, is in receivership. Any of these types of issues are bad news for you from a risk perspective. So you want to make a fully informed decision. When you're talking with your agent and broker, keep them posted on the developments in your business as well. For example, have you moved? There may be a geographic limitation in the policy. Have you acquired a new company? Will that be treated as an insured under the policy? Make sure that you're always updating them as to any changes in your business. It may also be that if you grow, you need more insurance. If you're signing certain contracts, they may have minimum insurance requirements that you have to meet or you're in breach of that contract. So again, early and often, check in with your insurance professionals and your lawyers.
And you know, Chris, some policies I've seen actually include some benefits that contractors and other companies don't realize are part of their insurance policies. For example, there are some insurance policies out there that allow a certain amount of resources to do a risk management program through the insurance company or at the insurance company's expense. And the insurance company benefits from that because certainly if they can reduce the risks in the first instance, they're paying out less over the long run. So make sure you take a look at your policy, ask your agent or broker, am I getting any of these benefits associated with the package I chose?
That's a great point. Absolutely. You want to go on and talk about some specific endorsements?
Sure. One of the specific endorsements you're going to see, which is very important, is the additional insured endorsement. Many contractors agree with owners or subcontractors, depending on their situation, about whether the insurance will extend to those entities should something happen. And a lot of times it's keyed off to what you're required to get for that other entity by virtue of your contract. So that goes back to the hypothetical I posed before. If someone gets injured on the job or there's property damage, if my indemnity is triggered, is my insurance policy going to cover my indemnity obligations? And that's something that you need to look very carefully at the language of the additional insured endorsements, because within those additional insured endorsements, you'll always see certain exclusions for your employees. And that makes sense because workers' comp will generally cover that. But does the employee exclusions extend to employees of subs? And will that exclusion also apply to anyone that you bring on as an additional insured through your policy?
And as we said earlier, if you have rights as an additional insured, make sure that they're actually endorsed to the policy. If let's say you're the general contractor and you have a subcontract with a sub, and the subcontract says that they will list you as an additional insured in your policy, don't simply accept that certificate of insurance. And remember, that's just a sheet of paper for informational purposes. It expressly disclaims any rights to coverage. What you want to get is a copy of the subcontractor's general liability insurance policy and see what the endorsement to that policy says with regard to your status as an additional insured. This would be a good segue into talking about how those types of policies fit together. Let's stay with the analogy. You're a general contractor and you've got a subcontract that gives you certain rights. You're upper in the food chain, so you have the leverage to require the subcontractors to provide you with some risk transfer comfort. Those normally take the shape of the subcontractor agreeing to indemnify you against any loss or lawsuit against you based on their work on the project or arising out of the contract. And also to list you as an additional insured on their policy. So if they're listing you as an additional insured in their policy, you've got to think how these two insurance policies fit together. You've got your own general liability insurance, and now you've been promised you'll be an additional insured on the subcontractor's general liability insurance. Let's say they both have limits of $1 million per occurrence. How does this play out when you finally get sued because there's been an accident on site? Well, when you get sued, you want to first take advantage of your coverage on their policy. So you'll tender your defense and indemnification to the subcontractor's general liability insurer. How's that going to play out? The first thing they're going to do is look at their insurance policy and your insurance policy. Each of them will have a provision called, quote, other insurance, unquote. And that provision dictates how the two policies fit together for this hypothetical loss. Now, normally they'll say, the other insurance will say, if the insured has coverage in addition to this policy, then this policy shall apply pro rata with such other insurance. In other words, they split the loss 50-50, pro rata. That's not what you want if you're the general contractor in this hypothetical. You want to be an additional insured so that you draw down your coverage on their policy entirely before you pay anything out of your policy. And the way you do that is to make sure that your additional insured status on their policy is primary. In other words, if you get sued and you claim on their policy, they're going to pay for the lawyer's bills, they're going to pay for the loss itself up to the $1 million policy limit on the subcontractor's insurance policy. After that, it's going to bounce back to your policy, which will be excess. So what you've done is you picked up $2 million insurance coverage. You've got to make sure that the other insurance provisions we talked about before fit together. The subcontractor's policy should say in that provision, if additional insured has coverage in addition to this policy shall be primary, and the other policy shall not contribute to it until it's exhausted. Likewise, your policy should have the other insured provision say essentially the opposite, that if the named insured general contractor has coverage on another policy, such other policy shall be primary, and this policy shall be excess. All right? When you've got those two fitting together, they're harmonious, and you've got a primary policy for $1 million, and your own policy becomes excess for $1 million. Now, if you don't do that right at the outset, the accident happens and you look at those two policies, and each of them in the other insurance provision purports to be excess, then you have no primary. The court will say those two provisions are mutually repugnant. That's what the language the court uses. And they both break down into pro rata. So now instead of having $2 million in coverage, primary and excess, which is what you intended, you're stuck with only $1 million in coverage. Half of it comes out of your policy.
And as Chris is talking about things fitting together, keep in mind that, and we've mentioned this before, but the contracts you have for indemnity also need to fit together with your additional insured endorsements. A lot of additional insured endorsements you'll see are what called blanket additional insured provisions. And those basically say, if you're required by contract to provide indemnity, we will cover that, whether that's as an additional insured basis or even what's called an insured contract basis. So you have to make sure that in order to get coverage, you are actually agreeing or being agreed to get that coverage in the first instance. A good example of that is what Chris mentioned, primary non-contributory. If your contract doesn't require you to get primary non-contributory coverage, you may not be getting primary non-contributory coverage.
That's right. That's right. So we've covered the additional insured endorsement. You want to talk a little bit about how indemnity works separately from that?
Sure. The indemnity provision means that if you're required to pay a loss, someone else is going to pay that loss for you. So whether that's through a contract, whether an insured contract or an additional insured status or an insurance policy. We also see a lot of these issues coming up in not just personal injury, that's the hypothetical we've been using so far, but what about work as well? There's often exclusions for your work and whether that's going to be covered by the indemnity. Certainly insurance companies don't want to go around insuring you for making mistakes on the job with what work you're actually performing. But what happens if you're performing work, let's say it's dealing with flooring that damages the rest of the property, or it's installing windows that then leak and causes damage to the property as well? These are issues where indemnity comes up and you may be looking for coverage. There'll be exclusions called your work exclusions in most of the policies. And that's doing exactly what I just mentioned, trying to exclude coverage for you getting a pass for just doing a bad job on the project, or so the insurance company would say. But what happens when your work damages other work, or your work damages other aspects of the property? You have to carefully read those exclusions. And you also need to look for things such as completed operations, whether after the fact something's discovered 2 or 3 years from now, whether there'll be coverage and indemnity for that.
You make a good point on the fact that there is no insurance for defective work. So if you just do a bad job, that's not covered. That's not a casualty loss that'll be picked up by your carrier or your policy. Normally, general liability insurance, which is sometimes called lawsuit insurance, covers a third party's claim against you for either a personal injury or property damage, generally speaking. What Matt presented was the second part of that, property damage. If you do defective work, but it doesn't cause any property damage or personal injury, there's probably not coverage under your policy. You're just stuck fixing it. Here's an example. Let's say you're hired to refurbish a whole dorm at Harvard University over the summer. You go in there and as part of the work, you're going to put in new doors. And unfortunately, your employees that day got every single one of the door jambs and doorknobs put in upside down. So they don't work. That's defective work. But when you make a claim to your insurance carrier to pay for the extra work it's going to take to go around to 500 doors and fix this, they're going to say, we don't insure you if you do a bad job. It has to be personal injury or property damage. So in this hypothetical, Matt, what if when we went back to fix this work, we're taking out the drill holes in the door and they're going in a different location? There's actually property damage to the door, isn't there?
There is. And that's a good example. Another good example I mentioned before is flooring.
Yes.
Windows also comes up. And this isn't just important for the indemnity aspects of paying to have it fixed. It's also for the defense aspect, because the insurer's duty to defend is greater than their duty to indemnify. So as long as there's an allegation and a complaint or a claim that this defective work also damaged other aspects of the property, you might very well have coverage for defending yourself and sticking up for the work you did. Perhaps the holes weren't drilled improperly. Perhaps it was done improperly at the direction of another. You're going to want to have some coverage there, so you're not paying your lawyers out of pocket for defending your work throughout a lawsuit.
That's a good point. Back to this hypothetical, if the general contractor is sued because the doorknobs were put in upside down and they make a claim and the claim is denied because it's just defective work or falls within your work exclusion, if that work was actually subcontracted out, then it wouldn't be your work for the general, right?
That's correct.
So that might be another way to get around it, is saying that it doesn't fall into the your work exclusion because, frankly, it wasn't your work. It was subcontracted to another party who did the defective work.
Yeah. And as Chris and I are throwing out these hypotheticals, these are hypotheticals we're thinking of in a general sense. But every business should be thinking on their own, what are the hypotheticals that I'm going to encounter? And taking those hypotheticals to your attorneys, to your risk management team, to anyone that can help you, your brokers, your agents, and take a look at your policy and say, based on this hypothetical and the language of the policy, the language of my contracts, will there be any coverage?
Yeah. And here's a different scenario we're going to shift to. Not necessarily a hypothetical. Frankly, it's the quintessential claim on a construction site. An injury to an employee on the construction site that leads to a personal injury lawsuit. Here's how it usually plays out under that food chain I told you about. Think of the food chain as like a totem pole. At the top is the owner. The owner's got the money and got the project. Hires a general contractor, who then in turn hires subcontractors, suppliers, and subcontractors. And it goes like this, and I say it flows down because normally the owner gets the best indemnity and additional short status, gets on these generals policies, gets on the subcontractors policies. And so when you have an injury, here's how it usually plays out. Back to the totem pole, you've got an owner, a general contractor, and say one subcontractor. An employee of the subcontractor is injured. Now, in Massachusetts, all employers generally are required to provide their employees with workers' compensation insurance coverage. This is what we call strict liability coverage. Doesn't matter if the employee was at fault, it was nothing wrong by the employer or any third party. Somebody's tripped over his own shoelace. If they're hurt in the course of their own work, they're entitled to workers' compensation insurance. And this insurance simply provides the injured employee with payment of its medical record, his medical bills, and some reimbursement up to about 2/3 of the average weekly wage they'd been earning. Now, the trade-off, because the employer had to buy this insurance, is that the employee cannot sue its employer. As long as the employer was the employer, directing the employee, and was an insured person responsible for the payment of workers' compensation and insurance coverage, it's immune from a lawsuit. Okay, those are the two pieces of the puzzle under Chapter 152, the workers' comp statute. And so when you're this injured employee in this hypothetical, you get the workers' comp from your employer, but is that all? Because it doesn't make you rich. It sort of gets you back on your feet. No, you can sue any other third party who's not your employer if they contributed to cause the accident. So in the typical construction accident case, an employee of a subcontractor collects workers' comp from his employer, the sub, and then goes around his employer to the general contractor or the owner or some other subcontractor, all of whom are not his employer and not immune from suit. Once that tort lawsuit goes, for example, against the general contractor or the owner, we're back to the food chain. This employee is suing the general contractor who sits above his employer, and the general probably has indemnification rights to require the employer to indemnify the general for this lawsuit by its employee. This happens all the time, and the indemnity provision is generally in the general's favor and the owner's favor, and is an exception to the employer immunity from a lawsuit. Because again, if the subcontractor here has to pay the general under indemnity, it's not paying anything directly to the employee. So that's how it normally plays out. You want to look at your insurance policies to make sure that you have coverage for such an indemnity obligation if you have this end around happen to you, and to see whether or not there is what is growing exclusion in these policies is exclusions for coverage to claims by employees of subcontractors. Now, it's kind of, when this first started coming out a couple of years back, I started thinking, what else happens? The typical accident on a job site is by a subcontractor's employee. So the insurers are trying to tighten the belt a little bit here, and you'll see that there are exclusions to this effect in many policies. And now for contractors and lawyers, there are moves afoot to try to get different types of policy coverage to pick it up.
Yes, and there's different types of forms that you might see as endorsements, and some may be broader than others. So you really have to carefully look at that language to see if it applies in your situation. And you have to look at it from the perspective of whether there's additional insured coverage from the subcontractor's policy to the general contractor and owner. But you should also look at it from the perspective of what's called an insured contract. And I think a lot of times the insured contract provision is overlooked. An insured contract is generally saying that we're going to insure you, the insured, for any contractual obligations you have, such as indemnity. Now, insured contracts are typically excluded under coverage. The insurance company doesn't want to be insuring every insured for every time they breach a contract. However, a carve out to that is if there's indemnity obligations within that contract. So it's something you shouldn't overlook when you're taking a look at your policy, and you have to carefully look at the exclusion to see if the exclusion excludes subcontractor employees' liability in the additional insured context, as well as that insured contract context.
That's right. Let's talk about a couple of other issues that come up in this insurance miasma on the construction site. First is, let's say you're a contractor and you have your own property insurance covering your property. That's what's called first-party insurance, because it's not protecting any third parties. It's simply you having your equipment insured, so if it's damaged, your property insurer will directly reimburse you. So, you have a backhoe, it falls over a ridge and is banged up and there's $10,000 in repairs. You make a claim on your property insurance policy and you think, okay, great, I got the check, I'm fine. Your property insurer might have a right to then file a lawsuit against somebody else in your name under a doctrine called subrogation. So if you're on a construction site, and again, in this hypothetical, the backhoe falls over a ridge, it's because another subcontractor hadn't shored it up properly. So your property insurer might be filing a lawsuit in your name against this other player on the same construction site, because your policy likely has a subrogation provision that says if your insurer pays for a loss, it has your rights to chase whoever caused that loss. So just be aware of this. It can be, a problem relationship-wise with general contractors, other players, owners, because you've given away the right for the insurer to sue in your name. If you want to avoid that, then in the construction contracts, put what's called a waiver of subrogation, so that all the construction parties agree they can inform their insurers that if something goes wrong, I get to collect my insurance, but my insurer does not get to go and sue in my name.
And another issue that comes up often are policies that are called all risk programs, or OCIPs or CCIPs. In other words, policies that cover anyone on the project. And Chris mentioned subrogation and rights among the different parties for property damage. A lot of times that can be wrapped up in those type of programs. And so on any construction project, you should first take a look at the documents and see if there is that additional layer of coverage that's going to apply to everyone, and see how that flows down in any type of dispute that may arise.
And you use the term wrap up, Matt. Frankly, that's what some of these insurance programs are called, wrap up insurance. The Big Dig, for example, we did a lot of work on that, and it was unique in that it had an owner's controlled insurance program. Mass Highway Department bought one omnibus general liability insurance policy through AIG. And then as Mass Highway put out the construction contracts, the contractors bid for the work without including the cost of their own insurance. Because if they got selected for the Big Dig work, they would be enrolled in this owner-controlled insurance program. They wouldn't have to pay for their own insurance. The beauty of the OCIP here was that it took away the food chain I talked about before. Everyone was covered under one policy, so there was no need to go for indemnification against each other, to seek additional insured status, or to subrogate. It was clean and efficient. But that's factored into the policy that the owner had to pay for this program.
And going to bring you back to the main point here is make sure you know what you have. Make sure you know what product you purchase. Make sure you know what the forms say. Make sure you're just vigilant, and as your company expands, your insurance coverage is going to expand. I'd just like to address one sort of horror story that I've encountered. I mentioned at the beginning different types of endorsements. I use the term subsidence. Subsidence exclusion is typically an earth movement exclusion. It says that if the earth moves and causes damage to property as you're doing work, then there won't be any coverage for it. It's an unusual term, but it's something that's very real in a lot of insurance policies. Let's say you're a contractor that does some excavation work. And let's say you even applied for insurance and told the insurance company that I do excavation work. It's sort of one of these categories that you list when you apply for insurance. What happens if there's a problem in the foundation as you're doing work? Could there be an allegation that this was due to earth movement? Even if you caused the earth movement from some of your work, is that going to exclude coverage? So I have seen scenarios where a company that does excavation and gets insurance for its operations is then being denied coverage because of this exclusion. So just be careful what you purchase. Take a look at your premiums too. If you're paying a large amount of premiums, what are those premiums for? A lot of times on the declaration pages, there'll be a breakdown of what those premium payments are for, so that you can look back at the different endorsements and you can look back at the different coverages to make sure you're all set.
As we wind up, I want to point out the obvious, which is you can't get insurance coverage for loss after the loss already occurred. So what we want to do is learn from the claims that have already occurred. We have a practice of meeting with our contractor clients after we've resolved the lawsuit to reverse engineer the facts. Say, how did this happen? Was it a training error? Was it a problem in the contract documents? What was it? And then we make sure that we fix it so the problem doesn't repeat itself. We urge you to do that with your insurance professionals as well, which is go out there, like for a medical checkup, have an insurance risk management checkup. And we help with that as well, because you need to make sure that you've got the coverage going forward so that you've transferred the risk where you can, and you've guarded against it where you can't by insurance programs. And you'll find that this type of insurance homework will pay for itself time and time again if you get it done right up front.
It only takes one lawsuit, one claim of this to realize that prevention is probably more important than having the coverage in the first place.
That's right. So thank you for joining us this morning. We do these programs periodically. They will then be recorded and you can check them online. If you have any questions following up here, please feel free to call us here at Kenny and Sam's. And thanks for joining us this morning.
Thank you.